Hello and welcome. Today we are diving into a topic that honestly catches thousands of people off guard every single year, UK capital gains tax. And to make sure we get this 100% right, we've teamed up with the specialists over at My Tax Accountant to bring you a really clear, straightforward guide for the 2025/26 tax year. So, if you've recently sold an asset and you're now wondering about the tax bill, stick around. We're going to get you some clear answers.
But let's kick things off with a question that might just surprise you. Did you know that HMRC might actually owe you money? I know, it sounds unlikely, but it is far more common than you'd think. Every year, people overpay on their capital gains tax simply because they miss out on reliefs they are completely entitled to, or they just get tripped up by the, let's face it, increasingly complex rules. By the end of this, you'll know exactly how to avoid those common mistakes.
Our goal here today is simple. We want to give you an expert-backed guide so you can feel totally confident about your tax obligations and, most importantly, make sure you're not paying a single penny more than you absolutely have to.
So, here's a quick look at our roadmap. We'll start with the absolute basics. What even is CGT? Then we'll get practical and look at how to calculate it, what the current rates are, and crucially, how to report and pay it on time. And we'll finish up with some really smart strategies to potentially lower your bill and talk about when it just makes sense to call on a professional.
Right. First things first, what exactly is capital gains tax? It's one of those terms that can sound a bit intimidating, but I promise the idea behind it is actually pretty simple. So let's break it down.
Okay, here is the single most important thing to get your head around. Capital gains tax, or CGT for short, is not a tax on the total amount of money you receive. It's a tax only on the profit, the bit that HMRC calls the gain. And it kicks in when you dispose of an asset. Now, disposing is a key bit of jargon. It doesn't just mean selling for cash, it could also mean gifting an asset to your kids, swapping it for something else, or even getting an insurance payout if something valuable gets lost or destroyed.
So what kind of assets are we talking about here? Well, the list is pretty broad. It covers the obvious stuff, like a second home or a buy-to-let property. It also includes shares and investments, as long as they're not tucked away safely in a tax-free wrapper like an ISA. Of course, business assets are on there too, and here's one that catches a lot of people out. Personal possessions, like maybe jewelry or a piece of art, but only if they're worth more than £6,000. And you bet, in today's world, crypto assets are absolutely on that list.
Okay, so let's get into the numbers. Calculating your gain can seem like a job for a math genius, but we're going to break it down into a really simple 5-step method. This is where you can start to see how it all works and, really take control of the process. So here they are, the 5 core steps. First, you figure out the initial gain. Second, you subtract any allowable costs from that number. Third, you apply any special tax reliefs you might be eligible for. Fourth, you use your tax-free annual allowance, and then finally, whatever is left, you apply the correct tax rate to that. Now, I know that sounds a bit abstract, so let's bring it to life with a real-world example.
To really see how this works in practice, let's walk through a super common scenario. Let's imagine a freelance graphic designer based in London. A few years ago, she bought a buy-to-let flat, and now she's selling it. Let's put some actual numbers to those 5 steps we just mentioned.
Okay, let's look at the numbers on the screen. Our freelancer sells her flat for £400,000. She originally paid $250,000 for it. So, step 1, the basic gain, is pretty simple. That's a profit of $150,000. But, and this is a big but, we don't pay tax on that whole amount. Next, for step 2, we deduct the allowable costs. These are basically the direct expenses of buying and selling. So think about the stamp duty she paid back in the day, solicitor's fees, and of course, the estate agent's commission. Let's say all of that adds up to £20,000. That brings our new adjusted gain down to $130,000.
And here is a fantastic tip, a critical deduction that so many people forget about: capital improvements. Now, this isn't for routine stuff like fixing a leaky tap or giving a room a lick of paint. This is for major projects that genuinely add value to the property. We're talking building an extension or putting in a brand new kitchen. Forgetting to deduct these big costs is one of the top reasons people end up paying way more tax than they need to. So, we've got our adjusted gain of £130,000. The next 2 steps are all about shrinking that number even more before we even think about tax. Step 3 is about applying any specific tax reliefs you might qualify for. And then step 4 is where everyone gets to deduct their annual tax-free allowance. Only after all of that do we arrive at the final number that's actually taxable.
And that leads us perfectly into our next section, the key rates and allowances. These are the really important numbers you need to know for the 2025/26 tax year, starting with that tax-free amount we just talked about.
For the 2025-26 tax year, the annual exempt amount, that's your tax-free allowance, is £3,000. This means the first $3,000 of capital gains you make in a tax year are completely 100% tax-free. It's really important to note this allowance has been cut dramatically in recent years. It was over £12,000 just a few years back, which makes careful planning more vital than ever. And remember, it's a use-it-or-lose-it allowance. You can't roll it over to the next year.
So for any gain you make above that £3,000 allowance, you're going to pay some tax. The rate you pay depends entirely on your income tax band. As you can see for 2025/26, basic rate taxpayers pay 18% and higher rate taxpayers pay 24%. Now here's the really critical part that catches so many people out. To figure out which band you're in, you take your total taxable income for the year, and then you add your taxable gain on top of it. If that combined total pushes you over the higher rate income threshold, then you'll pay the higher 24% rate on that part of the gain. It's a tiny detail that can make a massive difference to your final bill.
Okay, so once you've done the math and you know your rate, the next step is actually telling HMRC and paying them. This is the admin bit, and with anything tax-related, the one thing you absolutely cannot afford to mess up is the deadline.
This right here is probably one of the biggest traps people fall into, because the deadlines are completely different depending on what you've sold. For a UK residential property, you are on a very, very tight clock. You have just 60 days from the completion date of the sale to report it and pay any tax you owe. Just 60 days. But for everything else, like shares, crypto, or that piece of art we mentioned, you just report it on your normal self-assessment tax return, which isn't due until the 31st of January the following year. Getting these two mixed up is a surefire way to get hit with automatic late payment penalties and interest charges.
So who actually needs to tell HMRC about this? Well, there are two main triggers. The first one is pretty straightforward. If your total gains for the year are over the £3,000 tax-free allowance, you have to report it. But it's the second one that often catches people out. You also must report if the total amount of money you got from selling assets, what they call the sale proceeds, is more than £50,000 in a tax year. And this is true even if you made no profit at all and have zero tax to pay. It's basically HMRC's way of keeping tabs on large transactions.
All right, we've covered the rules and the process. Now let's get to the good stuff, strategy. This is all about smart, completely legal planning that you can do to potentially shrink your final capital gains tax bill.
Here is a seriously powerful strategy for anyone who is married or in a civil partnership. Any transfer of an asset between you two is completely tax-free. So what does that mean in practice? It means that before selling an asset that's only in one person's name, you can transfer half of it over to your partner. Then when you sell it, you can both use your individual £3,000 tax-free allowance against the gain. This one simple, legitimate step effectively doubles your joint allowance to £6,000 and can literally save you thousands in tax. It's not a sneaky loophole, it's a recognized part of tax planning.
And a quick one here for any business owners listening. This is absolutely crucial. There's a relief called Business Asset Disposal Relief, or BADR for short. If you qualify, let's say by selling shares in your own trading company or selling your business outright, it can slash your CGT rate all the way down to a flat 10% instead of 18 or 24%. This applies on up to £1 million of gains over your lifetime. It is a huge potential saving, but the rules are very strict, so it's vital to check if you qualify well before you plan to sell. We've covered a lot of ground today, from the calculations and reliefs to those all-important deadlines. But trying to navigate all of these rules, especially if your situation is even slightly complicated, can be a bit risky to do on your own. And that brings us to our final section, knowing when it's time to call in a professional.
So why bring in an expert? Well, really, it comes down to certainty. An expert can make sure your calculations are spot on, including all those tricky things like correctly deducting capital improvements. They'll know every single relief available, not just the common ones, to make sure you're not overpaying. They manage the deadlines, which means you avoid those nasty penalties for a simple admin error. And honestly, above all else, it just gives you complete peace of mind knowing everything is handled correctly, compliantly, and in the most tax-efficient way possible.
Look, capital gains tax can be complex, but as we've seen, just understanding that 5-step calculation and knowing a few key strategies can make a world of difference. If you're dealing with a capital gain and you want to be absolutely certain everything is handled perfectly, the team that helped put this guide together, My Tax Accountant, can give you that expert help. You can reach them directly on WhatsApp or by phone on 07854 255 375, or you can drop them an email at info@mytaxaccountant.co.uk. For more clear, jargon-free guides just like this one, make sure you subscribe to their YouTube channel. Thanks so much for joining me today.